Welcome to CoreLogic's update on housing market conditions for August 2018. The month of July saw the housing downturn gathering some momentum on a national basis. The 0.6% month-on-month fall was the largest decline since September 2011, and the rolling quarterly change at negative 0.9% hasn't been this low since January 2012. 5 of the 8 capital cities saw values slip lower over the past 3 months, and trends across the regional housing markets, where conditions have generally been more resilient to falls, have also turned negative. The weakness in dwelling values is being driven by the long-running declines in Perth and Darwin, along with an acceleration in the rate of decline across Sydney and Melbourne. Outside of these cities, growth rates are generally slowing as tighter credit conditions broadly dampen housing market activity. Across the capital cities, Melbourne has been leading the downturn, with the quarterly rate of decline outpacing Sydney's since May this year. Melbourne dwelling values were down 1.8% over the past 3 months, followed by Perth at 1.5% and Sydney, where the market was down 1.1%. Melbourne's decline phase commenced 5 months later than Sydney's, with the market peaking in November last year. Since that time, Melbourne dwelling values have fallen by 2.9%, while in Sydney, where values peaked 12 months ago, the market's down 5.4%. Those cities where values continue to trend higher have also seen a sharp reduction in the rate of capital gain. In Brisbane and Adelaide, where housing values were rising at a much more sustainable pace over the past 5 years, the annual rate of capital gains has weakened. In Brisbane, the annual growth rate has eased from 2.9% a year ago to 1.2% over the past 12 months, and in Adelaide, the annual growth rate has dropped from 5.4% a year ago to just 0.7% over the most recent 12-month period. Focusing on the regional markets, dwelling values were down 0.2% across the combined regionals index over the 3 months ending July, driven by falls across regional New South Wales, where the market was 0.2% lower. Values were also down 0.6% across regional Queensland and regional WA, which recorded the largest declines over the quarter, down 3.5%. While 3 of the 7 rest of state regions saw a fall in values over the 3-month period, the pace of growth across the remaining regional areas has clearly decelerated, contributing to the overall softer national result. Overall, we can't see any factors that may halt or reverse the housing market's trajectory of subtle declines over the second half of 2018. The availability of housing credit has been a significant contributing factor to this slowdown. However, there are a variety of other hurdles contributing to the slower conditions. From a credit perspective, the latest credit aggregates from the Reserve Bank of Australia highlight that owner-occupier lending has continued to grow at a relatively strong pace, up almost 8% over the 12 months to June. The same data highlights that the slowdown in credit growth is attributable almost entirely to less investment lending, where growth is tracking at a record low of 1.6% annually. Although the 10% speed limit on investment credit growth has been removed for eligible lenders, we aren't expecting to see a rebound in credit availability for investment purposes. Mortgage rate premiums for investment loans remain in place, and the limits on interest-only lending continue to provide disincentives to housing market investment. Additionally, market factors such as low rental yields and dim prospects for short to medium-term capital gains are also likely to quell investment demand. Higher housing supply is another factor that's likely to weigh on some sectors of the market. Unit construction remains well above average across most states, and it's at record high levels across Victoria and South Australia, and only marginally below the record high in New South Wales. Coupled with high supply, key segments of demand, including domestic investors and foreign buyers, have thinned out, which could see some downwards pressure on prices, particularly in those areas where new investment-grade projects are numerous. Migration trends have also changed, which is likely to have both positive and negative impacts on housing market demand. Although Australian Bureau of Statistics demographic data is only current to December last year, it's clear that New South Wales is seeing a growing exodus of residents to other states, while interstate migration rates to Victoria appear to have peaked as well. The reduction in migration implies reduced housing demand in these locations. Queensland is the major beneficiary of cross-border resident flows, which should help to support housing demand, especially across the southeast corner of the state. Despite the reduction in dwelling values in Sydney and Melbourne, housing affordability remains a pressing issue in these cities. The ratio of dwelling prices to incomes was tracking at 9.1 in Sydney and 8.1 in Melbourne at the end of June. Although these ratios are likely to improve as incomes edge higher and as housing prices reduce, prices would need to fall a lot further to see this measure of affordability return to more adequate levels, especially when you consider where these ratios are relative to the other capital cities. While dampening factors are clearly at play, consistently low mortgage rates will continue to provide a support buffer which should help to keep a floor under housing demand. Owner-occupiers continue to enjoy mortgage rates at the lowest level since the 1960s, and although investors are paying around a 60 basis point premium on their home loans, interest rates remain low for this segment of the marketplace as well. Higher funding costs could see mortgage rates edge a little bit higher. However, we'd need to see mortgage rates rise by more than 150 basis points before they return to the 20-year average of 6.8%. Even though smaller lenders have increased owner-occupier mortgage rates, some larger lenders have recently reduced interest rates for certain owner-occupier mortgages. Considering the 30% limit on interest-only loan originations and the stiff interest rate premiums for interest-only loans, it's likely we'll continue to see owner-occupiers gradually consume a greater share of market activity relative to investors going forward. With the housing market changing rapidly, it's becoming even more important to stay across the trends, as well as the key economic and demographic factors at play. The CoreLogic research pages are maintained with a frequent update schedule across the key issues. So stay up to date at www.corelogic.com.au.